Well, welcome to another Smart Silver Stacker live stream. We've got a lot to talk about today, specifically the fact that the US is now preparing for a massive dump of US treasuries by China. And this could have some very significant impacts on the purchasing power of the US dollar. We're going to get into that. And also, of course, because they are essentially an inverse to the dollar, could have a major impact on the precious metals as well. So we're going to get into that today. How many, U.S. Debt, how much U.S. debt China is holding, why it may be dumping that very soon. And yes, a happy Father's Day to everybody who's tuning in. All the dads out there, if you are watching, thanks for spending part of your day here on this live stream. So let's get right into it. Earlier this week, we had Janet Yellen testifying before the House Financial Services Committee, I believe. And she's telling us that a decoupling from China could be disastrous. Now, that's fairly obvious, I think, because our economies are quite intertwined. And here's the quote from Yellen here, testifying before the House Financial Services Committee, saying, "I think we gain and China gains from trade and investment that is as open as possible. And it would be disastrous for us to attempt to decouple from China." And, to give you further evidence that the U.S. is taking this threat pretty seriously here, U.S. Secretary of State right now is on a trip to China. Antony Blinken, he is visiting China right now, trying to smooth over some of the difficult, we can say, relations between the two countries. I mean, we had the Chinese spy balloon over the country earlier this year. We've had quite a bit of brinksmanship in the South China Sea related to Taiwan and China's territorial claim there and the U.S. involvement. And so, it looks like the powers that be kind of understand that there is a major threat here should the U.S. and China come to blows, a major economic threat. And not the least of which is the $85.9 billion worth of U.S. treasuries that China is holding. China is the second largest foreign holder of U.S. debt. And Peter Schiff pointed out something very interesting recently in a podcast of his I was listening to, that not only do the Chinese have the $859 billion worth of U.S. treasuries, also, if you look here on the list, Hong Kong holds $226.8 billion worth of U.S. treasuries. And you can essentially combine that with the Chinese holdings because Hong Kong is part of China. It's controlled by China. So they control a lot of U.S. debt. When you add Hong Kong and Chinese holdings together, they're very close to the number one spot. Yeah, it's very close to $1 trillion, very close to Japan there. And should China decide to dump those U.S. Treasury holdings, it could be an absolute disaster for the U.S. economy and also for the purchasing power of the dollar. Now, we're going to get into some of the reasons why and why it's not just the fact that they hold $1 trillion in debt, because, we've got $31.8 trillion of public debt outstanding. $1 trillion is a lot, but it's not, a huge amount. But there are some factors that are at play here that could make a Chinese debt dump far, far worse than it might appear on the surface. And that is why we've got these warnings coming from Janet Yellen. We're going to get into all that. First, a quick commercial from our channel sponsors. Before we get to that, sdbullion.com, they've got these kilo bars on sale right now, $1.96 over spot. And when you look at what's going on with China and with the possibility of them dumping their U.S. Treasury holdings, the fact that this could be a huge step in the de-dollarization process, I think it is a great time to be getting into hard, physical, tangible assets, inflation hedging assets like precious metals. So make sure you check out sdbullion.com. They've got these Argo Horace bars, like I said, on sale. Basically, very similar to this one. I've got another one on the way, and I just think that silver at these prices is a huge bargain. Also, don't forget to check out silverbotanicals.com. There's a link down in the description. They've got these amazing personal hygiene products that are powered by nano silver. You can use coupon code STACKER to save 10% on your purchase there. Thank you very much for the super chat there. Unloading the car from Family Vacay. I'll be back. Okay, well, don't forget you can always tune into these live streams after the fact too. So this is the official data here from the U.S. Treasury on major holders of major foreign holders of U.S. Treasuries. And you can see here, I know the data is formatted a little weird here, but if you go back about a year, the Chinese holdings here at over $1 trillion, and now they have declined. This is the most recent month to 859.4. So the Chinese are already dumping U.S. debt. The decline has been significant. I mean, it is over time. It's kind of a slow bleed rather than a major dump. But the Chinese are doing this because of these declining relations between the two countries. Also, the major threat of de-dollarization. They don't want to be holding U.S. dollar-denominated assets in the event that we do get into a conflict with them, because they've seen what has happened to Russia. Russia's dollar-denominated assets frozen. If we go to war with China over Taiwan, should that break out, we've had U.S. generals warning that it could happen as early as 2025. You look at all the brinksmanship there in the South China Sea, it could happen at any time should a mistake or a miscalculation be made. And they know that that $859 billion worth of debt that they have could become worthless overnight should we come to blows. So they have been dumping those. But if we do come to blows, it is likely that they will just drop them in a coordinated way. And I want to play this clip from you from Janet Yellen's testimony here. Let's see. Let's go ahead and play it. I'll try to have the audio on here.
Exercise, and in response to sanctions against a Chinese scenario where there will be an invasion, Taiwan, the scenario was that China, the second largest foreign creditor of U.S. Treasuries, would dump that $859 billion in Treasury securities. How are you working with our allies internationally and also the Federal Reserve to deal with a situation where China would dump that volume of Treasury securities overnight?
So we are not engaging in specific exercises to address such a risk, but the United States, the National Security Council, is certainly concerned on an ongoing basis.
Well, Madam Secretary, I would encourage Treasury to make preparations and be on the ready for that scenario and work with.
Okay, so there you have it. Members of Congress warning Janet Yellen to prepare, to have a plan in place, should the Chinese decide to dump this debt. And, they mentioned working with the Federal Reserve, and this is where the real risk to the dollar comes into play, because I can tell you that if the Chinese dump their debt and we see a major spike in interest rates as, these treasuries flood the market, existing treasuries, then their Federal Reserve will have no choice but to come into the market, become the buyer of last resort, and begin buying up some U.S. debt with QE, a resumption of quantitative easing. And it's not just, again, the risk that China is going to be dumping their debt. There are a number of other factors at play here that we should be paying attention to. First of all, is this possibility that since the debt ceiling was just suspended and Congress gave the go-ahead to issue more U.S. debt, markets are bracing for a deluge of Treasury bill supply. This is from Reuters from June 5th. And according to some estimates, there will be $1.3 trillion of new debt issued by the end of 2023. So you can see they're expecting $400 billion worth of debt to be sold in June, $500 billion between July and September, and then by the end of the year, $1.3 trillion of new debt issued. Because we went over this in a previous video, but because the debt ceiling was looming and they weren't issuing any new debt, the Treasury's cash had declined to very, very low levels. I think they were down to $60 billion at one point. So, the government is still spending tremendous amounts of money. They've got all these entitlement payments that need to go out. And so they're going to need to borrow a tremendous amount of money. Now, what does that have to do with China? Well, we know that the Treasury is going to be selling a ton of U.S. debt throughout the rest of the year. And moving forward, it's not like by the end of 2023 they're going to be done. The debt ceiling has been suspended until January of 2025. So if China comes in either with a concerted debt dump or even just the continued slow bleed, this is going to exert a lot of upward pressure on Treasury yields because that's how bonds work. The more of them get sold into the market to attract buyers, you have to raise interest rates. That is how the bond market functions. And so the the Treasury will be competing with China to sell these U.S. Treasuries into the market. And it's not just them either. You also have to remember this is the Federal Reserve balance sheet. And we had this massive spike up back in 2020. We also had, since the 2008 crisis, this expanded, but they have been drawing it down. And that means they are also going to be competing to sell U.S. Treasuries. So everybody's going to be selling U.S. Treasuries. Who's going to be buying them? Well, the rates are going to have to rise quite a bit in order to attract those buyers. Now, why would that be a problem? Well, remember the banking crisis that we've been going through this year. What kicked it off? The reason that we've had the bank failures that we had this year was because these regional banks were holding U.S. Treasuries on their balance sheet. Now, the Treasuries that they have, they bought years ago, and they've declined in value because of the rise in Treasury yields. So, when bond yields go up, existing bonds that have a lower yield, they go down in value. And so if we see a spike up in interest rates or a spike up in treasury yields, that means that all of these troubled assets that are on these bank balance sheets are going to continue to decline even further in value. And that means that should we get some kind of liquidity event, some kind of a run on the banks, depositors want to get their money out, they're going to force these banks to sell these treasuries, just like what happened with SVB, except the losses will be significantly worse if we see treasury yields continue to rise. And that is exactly what looks like we might be facing. Now, one other chart I want to draw your attention to here is this one. We've covered this before, but this is a chart, a long-term chart of the federal funds rate. And I've added in this red line for you. And this goes back to 1980. You can see where the rates were extremely high here. That's where Paul Volcker jacked up rates to get the inflation of the 1970s and early 80s under control. But since that time, we have had a steady decline in the federal funds rate. And the reason I had this red line is because you can see that every time the federal funds rate has touched this downward sloping line, there has been some kind of a crisis which has forced the Federal Reserve to slash rates. Now you can see this one, this is the dot-com bubble. Then we had the 2008 financial crisis. Then we had the 2020 crisis. We know what that was about. I don't want this video to get censored, so I'm not going to name it, but we know what that was. And every time the federal funds rate hit this downward sloping line, we had a financial crisis. But look at where we are at right now. I mean, we have blown through that downward sloping line. And already we have got a bigger banking crisis this year than 2008. But one of the things that we had in 2008 was the Chinese, at least, were still buying U.S. treasuries in a big way. Now, if they begin dumping that, I mean, things are set up here for a massive financial crisis in the U.S. The dominoes are getting arranged because if we have $31.8 trillion in outstanding debt, back in 2008, it was less than $1 trillion. We've got foreign buyers threatening to dump the debt holdings that they have. We're not able to export all of this inflation around the world any longer. We've got the U.S. Treasury issuing this massive level of debt, so they're selling more treasuries onto the market. And also, back in 2008, the Fed, their balance sheet was close to zero. I think they had a few things on there, but it was under $1 trillion. They were able to come into the market and save things by doing QE. And then, we know how that worked out. They had to resume QE in 2020 to a massive, $4 trillion increase in their balance sheet. Well, this time around, there are so many factors aligned here that should we go into this financial crisis, the Fed is going to be starting at a time when inflation is already extremely high. In 2008, inflation was well under 2%, under the Fed's, goal that they repeatedly state. But now we've already got high inflation. We don't have foreign buyers to buy up these treasuries. We are spending money hand over fist. I mean, the deficits here in the U.S. have gotten out of control. We've already got a tremendous amount of debt. So when this shoe drops, and it could start very easily simply with the Chinese dumping this close to $1 trillion that they hold in US debt. Well, the Fed very likely is going to come back into the market and save things, or quote unquote save things. I mean, really what they're going to do is save this, nominal house of cards kind of economy, but they're going to be sacrificing the dollar's purchasing power to do so. The last time that they came into the markets and bought up all these US treasuries with QE, inflation was already very low. But this time around, we're starting off from a very high level. They already have over $8 trillion on their balance sheet. So, we all know that sentiment is essentially what drives markets, right? I mean, you can tell that just because when the Federal Reserve opens their mouth, anybody from the Federal Reserve, you see the silver market begin to move. But what's going to happen when whoops, Butterfingers here, when it becomes obvious that the Federal Reserve has abandoned their inflation fight and that the rest of the world no longer wants to buy US debt? Well, I think investors are going to realize that inflation is going to run out of control. And when that happens, there will be a massive flight into precious metals, into gold, into silver. And at that time, paper instruments, SLV, futures contracts, none of that is going to be worth holding. What you are going to need is real, tangible, physical metal. The kind that you can hold in your hand, the kind that makes a nice silver clink when you bang them together. And that is why I am still stacking. And that is why we should all be very concerned about this potential dump of US debt by China and by other holders of treasuries around the world. The Saudis might jump on board. Who knows who else might jump on board this debt once it gets going, because I think it could be sort of a self-fulfilling prophecy, sort of a self-reinforcing mechanism. You get the biggest holder or second biggest holder of U.S. debt dumping it. Well, other countries around the world might get a little worried that they might not see a return on those assets. And one last thing I want to say before we wrap this up is that holding U.S. treasuries has become a lot less appealing to all of these countries around the world following this most recent U.S. debt ceiling drama. Because if you recall, I mean, Janet Yellen said, if we don't raise the debt ceiling, we could face a default. So what does that tell holders of U.S. treasuries around the world? It tells them that the U.S. is broke and that if we don't borrow more money, we're not going to pay you. And so that is a shocking admission, which, it doesn't really seem to be priced into the markets yet. But I think eventually, and in the relatively near future, all of these holders of U.S. treasuries around the world are going to begin to understand that the only way they're ever going to get paid back is with more borrowed, more devalued currency. And so a U.S. debt dump is growing increasingly likely. Now, we do have to remember that this would be quite detrimental to the Chinese economy as well. We are deeply intertwined with them as trade partners, but if a war breaks out in the South China Sea, all bets are off. And I don't think that they will hesitate in the least bit to dump those near $1 trillion of U.S. treasuries. So leave me a comment down below to let me know what you think about this development. What do you think the effect could be on the dollar, on the precious metals? Do you think it's even possible? Are the Chinese considering dumping the U.S. debt that they hold? I would like to know what you have to say, so let me know in the comments. Thanks for watching, everybody. Happy Father's Day. Thanks for watching. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.